Chris, you can hear me? Okay.
Morning.
Morning, Alan.
Always good to know that this is actually working. People can hear me and I can hear them.
I know, it does feel reassuring.
Good morning.
Hi, Lazaro.
Hello. Lori, are we waiting for anybody else?
I don't see Ethan.
Okay. Give him a few seconds, and if not, we'll start. We have a quorum though, right? Even without Ethan.
Correct.
So I think we should probably get started. Oh, there he is. Morning, Ethan.
Morning. How you doing?
Good, how are you?
Good.
All right, it's 7:46. I'll call the meeting to order. Let's see. Do you want to take the roll, Lori?
Sure. Will you be doing also the regular?
The opening comments?
Yeah, so I'll do the roll call now.
Sure.
Okay. Lori Carney, Clerk of the Board. Lazaro Guzman,
Present.
Perry Salonia,
Present.
Al Lebo,
Here.
Ethan Goldman,
Present.
Brittany Birmingham,
Here.
Peter Privatera,
Here.
Mayor Cantor, she may be muted. I see her on the screen.
Here. Can you not hear me?
Oh, I can hear you now.
Okay,
Thanks.
thank you.
Thanks, Sherry. Chris Kashmar,
Present.
Rick Ledwith,
Here.
Paula Kanaki,
Here.
Matt Hart, and Lee Gold. No. Is there anyone participating whose name I have not called? All right, Lazaro, you can begin.
All right, Lori, thank you. So a few comments before we begin. Welcome to the November 15th regular meeting of the West Hartford Pension Board. My name is Lazaro Guzman and I'm the chair of the board. This meeting is being conducted in a virtual format in accordance with the Freedom of Information Act as amended by Public Act number 21-2, which authorizes municipalities to conduct public meetings virtually. Members of the public can view the meeting live on West Hartford Community Television at www.whctv.org and www.youtube.com/WHCTV5. The meeting is also being recorded for on-demand viewing and will be available on the town's website for at least 45 days. Since we're conducting this meeting in a virtual format, there are some special rules and procedures that I need to cover before we begin. First, I ask all participants to mute your devices when you're speaking. If you wish to be recognized, please raise your hand and I will call on you in the order I see hands raised. If you are participating by audio only, or I do not call on you and the debate is ending, then unmute your phone and let me know so that I can recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions still require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second the motion by just unmuting their line and saying second. Third, all speakers must make a good faith effort to state the person's name and title at the outset of each occasion that such person participates in the meeting. Fourth, all votes must be taken by roll call unless the vote is unanimous. Fifth, a reminder that if any participant has a problem with connectivity, you should immediately call Lori Carney, whose phone number you were provided earlier. She will let me know and we will recess the meeting while the problem is resolved. If it cannot be resolved quickly, we will ask you to call into the meeting using a phone and participate via audio only. All right, Lori's already called the roll. Thanks to everybody for joining. I think first on the agenda, we have Peter Privatera, Director of Finance.
Thank you, Mr. Chairman. Pete Privatera, Finance Director. I do not have any specific items. I do know that there are a number of questions that are going to be asked regarding the bills that came in from Millman. So I'll just defer to that point in the agenda. Thank you.
Thank you, Peter. Next up, Chris.
Right, good morning. Thank you, Mr. Chairman. Chris Cashmore, Fiducian Advisors. I think Lori and I worked out the technical kinks, so we're going to try to bring up our slide deck and just hit and highlight a couple of pages for you. As always, there's lots of materials and statistics there, and we had hinted at, I think, some of the third quarter capital market activity on our most previous meeting, but we'll formalize those data points momentarily here. Once Lori has the deck up and get you moving on your way. And if we could, Lori, I would skip all the way to slide 8, if you would, page 8, lower right-hand corner. What we've done this quarter, as you'll remember, is we do warehouse some actuarial trends nationally and locally. Those trends relate to funded status and some performance statistics and the like. The data we catalog, as you know, is obviously subsidiary to the Milliman work, and a lot of it is from prior to POB issuance data points. So I'm not sure that it's particularly relevant, but it's captured there for the record nonetheless. We don't have further comment on it. The one data point that is a bit more topical, just as a point of comparison, perhaps, is the page Lori's on now. It's kind of an interesting and an ancillary data points for the board. Milliman actually collects this information nationally. So you'll see here a host of statistics relating to portfolio performance. And then the one thing I might offer up just as a reminder to the board, you'll see the very first bullet there for the calendar, the fiscal year, ending 6/30/2021. The 100 largest pension plans nationally earned a return just slightly south of 20% there. Just to catalog, you'll remember for the pension board, the town's experience was much stronger than that. If you go back to our second quarter report, you'll remember that the town plan achieved a return of almost 30% over that same 12-month period. It was actually 29.9%. So fairly kind of significant outperformance of those larger national averages. Some of that, as you all know, is a byproduct of those bigger plans being in certain segments of the capital markets, hedge funds, for example, and other alternative investments that in the big ramp up after the pandemic and the improvement in public markets, some of those areas of the markets didn't quite keep pace on a relative basis. So I think that probably explains the differential, the big differential in favor of the town over that 12-month period. If you skip, Lori, to page 9, just as an additional frame of reference for the board, you'll see there just some trending information from the state of Connecticut and average funded ratios. Again, just really for your edification, nothing to act on here, but you'll see for the fiscal year ending 2020, if you can make it out there in the chart, about a 72% funded ratio for plans around pension plans around the state of Connecticut. Really, again, nothing to act on, just information for the board. But before we segue into a quick update on markets and the portfolios, any questions from the board on this admittedly generic actuarial information?
Ethan, do you have a question?
Yeah, and I don't know if this is to Chris or this is to Peter or someone else. The schedule I was interested in actually predates the one or the numbers. Number 7, the actuarial, the total accrued liabilities. Is there any way to get a historical of that, like for the last 10 years? Because it would be good to, the assets are great and understanding the assets and seeing the change in the assets, but we don't really spend, I'd just like to see the liabilities for like the last 10 years just to get a flavor of the progression. So if there's no immediate, it was just a request for, as I was reading everything this weekend. And I don't know if that comes from Chris or from someone else. That's all I have.
Chris, that I would think comes from our actuary, correct?
Yeah, that would, I think, be, Mr. Chairman, the most direct place to get it for sure.
Well, I would even think it'd be in the financials of the town every year, since it's annual. Well, however you get it.
We'll make a note, Ethan. I think, yeah, I mean, I know that we probably have a record from the actuary, and it may be in the financials as well. We'll
Okay,
see
either
what's
way
best place.
is fantastic. Thank you.
Okay.
Great, we'll forge ahead here and of course.
Excuse me,
along the way,
excuse me.
If we could,
Excuse
Lori,
me.
skip to.
Sorry, Chris. Al has another question.
Sorry.
Yeah, Al Leba, board member. Yeah, Chris, I had a question for you as well. On page 8, I had assumed that the difference in the returns that you were talking about there had to do with the relative percentage of investment in equities versus fixed income. Isn't that a major factor in our return versus the average here?
I think, Alan, is to an extent, right? But I don't know if I don't think you're that differentiated in your equity stance versus these larger systems that would explain that full 10 percentage point advantage, right? That might be some of it. But I think even if you look at surveys of these plans and, we don't have perfect control, right, and vision into their ultimate allocations. But I think for mature systems around the country, a 2/3, 1/3, a 60-40 type mix, equity versus fixed income, is not atypical. Where they are differentiated, I think more meaningfully is in some of these extended asset classes, right? Things like hedge funds and maybe private capital opportunities and the like, right? So that's kind of difficult to control for with precision. I think the short answer is right. There may be some advantage in favor of the town by virtue of your 70 some odd percent commitment to public equities, explaining a bit of it, but perhaps not all of it, if that makes sense.
Okay, and I guess the other question related to that is the big loss in Q1 of 2020. Can you remind me how we did compared to the average here?
Yeah, I would. I'll have to pull it for you, Al, if that's okay. I can pull that and I'll share that with Peter and Lori and get it right back to you. I don't have it offhand, but it's something I can access quickly and get right back to you.
All right, because I'm thinking that we were probably further there, that our returns are just more extreme than the returns here in either direction.
That intuition may be true.
Okay.
We'll get you that for sure. Okay, I don't see anything else on this portion. Again, just stop me if I miss something. Lori, if we could jump to page 10, and I don't want to spend, I think you just had it up there. I'm sorry, go to the next page if you would. Exactly, thank you. 11, I'm sorry. Just quickly, I think we had teased some of these themes out at the last meeting, but just as we come into calendar year end, I think we all have a fairly good sense that the narrative has shifted a little bit over the last several months. And investors have been grappling with, as we all know, a couple of things. Probably most prominently has been the changing message with respect to the Fed's intentions on stimulus, right? So whether that comes in the form, consternation comes in the form of we're going to start to reduce our monthly purchases of Treasury and mortgage-backed securities, which the Fed has stated is their intention to begin to take hold over the next several months. And then moreover, in the back half of 2022 and certainly into 2023, a decided expectation from the markets, not discouraged by the Fed, that they're going to begin to hike interest rates, as you know. And you see there, if you can make it out on Lori's page in the upper right-hand corner, we just show you the kind of the now infamous dot plot. And these are just data gathered in summary fashion from the Fed governors who vote on rate policy. And if you can make it out there, we've highlighted 2023. The markets have begun to pull in, pretty decidedly this expectation shared by many of the governors that rate hikes are forthcoming in fairly near term. So that has provided certainly a little bit in the way of markets kind of recalibrating, right? We've seen, September was a weak month for risk assets. October was a stabilizing month. November, actually, month to date, as you've seen, has been a pretty decent month as well. So that transparency around that Fed messaging has certainly earned them a bit of credibility with investors, we think. That's something that they see markets seem to be navigating fairly well. We've obviously had a bit in the way of gridlock in Washington on the policy front. I suppose some progress there with the infrastructure bill passing and more in the way of bills perhaps coming. So maybe that avenue is a little less fractious as well going forward. And unfortunately continue to struggle a bit with the Delta variant, of course. So that is mixed in again to this idea, as we'll see momentarily, that markets Q3 returns were actually fairly modest as investors try to work their way through some of these changing circumstances. Perhaps the one thing, and I think it's garnered some press, and it's certainly something we've spent some time thinking about, but the one thing maybe that can serve as a bridge through some of this noise into that maybe next wave of economic activity and pickup on that front is how strong the consumer is financially. So you see in the bottom left-hand corner, you can make it out there. We're just cataloging two things here, net worth for investors and then levels of indebtedness. And you can see, if you can make it out, since the onset of the pandemic, both those measures have accrued pretty strongly in favor of consumers. Consumers, we think, are in very good financial health. And that is perhaps one thing that I factor in, a meaningful one that can bridge us through some of this noise near term. As we all know, consumers are a full 70% of economic activity. So obviously that's a critical component of the path that the economy will take. And then the final thing I'd offer up as a bigger theme is in the lower right-hand corner. This is something we've talked about many times, right? And that's just the pattern of capital market returns since the onset of the pandemic. And just as a quick reminder for all of us, you'll remember back in the spring of 2020, when the Fed had put out all the stimulus that they had in really historic proportions, the market stabilized a good deal, but it was the large cap equity names in the U.S., the growth names, and moreover the tech names, you'll remember, the so-called pandemic resistant names that really led the charges, were the big upshoot in the spring. And everything else stabilized, but was struggling to keep pace. We had that broadening pattern of returns, you'll remember, from the fall of 2020 through this spring, 2021, where we saw small cap names, value equities, even international equities to an extent outpacing large cap U.S. growth. And that was an encouraging thing, right? Those patterns often foreshadow, at least historically, kind of good economic outcomes and decent capital market returns. We did have a reversion back, and that's the chart in the lower right-hand corner to kind of back to the beginning, if you will. And we did see it was large cap and growth names at that in Q3 that were the best performers. Again, for Q4 to date, we've actually seen that pattern turn a little bit. So not surprising, right? As investors kind of grapple through to the implications of Fed actions and the like, you'll see some of that volatility in that return pattern. So that is a kind of big picture thematics. If we could jump to the very next page, Lori, and we'll just spend 30 seconds on it because I'm maybe anticipating, there it is, thank you, anticipating a question or two. The other two big undercurrents, right, and I think what everyone's talking about is inflation. And certainly headline inflation has jumped up meaningfully. You see that in the lower right-hand corner of the page. We just show you both headline inflation and then the core number, the ex-food energy number that everyone talks about. And you can see the big uptake over the last several months. And I think, as you all know, right, the Fed story around this has been, we believe ultimately that we expect this higher levels of inflation, but that ultimately it'll prove to be transitory. And once we get supply chains recalibrating and product back on shelves, that demand supply imbalance will begin to soften and we'll kind of revert back to something more typical on the inflation front. But it is a byproduct, what we're seeing right now, right, of consumers want to spend. They have the ability to spend. and there's just not necessarily the product to spend. So it's kind of a curious thing, right? There's certainly a lot in the way of demand, and that's kind of pulling those inflation statistics a little bit out of whack. And so the upper right-hand corner there, you see inventories to sales, the big spike, right? As you might expect with supply chain disruptions being a story. I think we have talked about, right, that I think in the past that we share, I think, the Fed sentiment ultimately, right, that inflation will begin to soften a bit. You've seen activity around, ports operating at 24 hours. You've seen China bringing coal production back online. There's anecdotal stories around some of those supply chain frictions beginning to soften up. So we do ultimately think that probably comes back. Those inflation statistics come back and are more manageable. It may take, a couple of quarters, but more manageable, ultimately manageable. And really, these temporary increases we've seen shouldn't take the next wave, if you will, of economic growth off the rails. We don't show it here, but just as a statistic for those interested, the markets will use what we call break-even rates, right, to monitor inflation expectations. That rate is the difference between yields on nominal 10-year treasuries and their TIPS equivalents, their Treasury inflation protected security equivalents. Those numbers today are running at about 2.6%. Right? So that's the market's expectation for inflation over the next 10 years. Right? That number is certainly higher than where it was pre-pandemic when we were down a little bit below 2%, but it's not running at levels that are extremely elevated. Right? So there's no kind of embedded expectation from investors that we're going to have runaway inflation and that it's going to be rampant for an extended period of time. So, if you accept that premise and those markers, again, we think that, we've got the makings of inflation ultimately coming under control here. So those are that's kind of, I know it's a topic of du jour and people are spending a lot of time thinking about it. If we could, Lori, just jump, and then I'll pause for a minute for the board, but if we could just quickly jump to the very next page, it's got an exhibit that should show capital market returns for, there it is, thank you, for the quarter. And the numbers are small here, but if you read through your materials ahead of time, you'll see that it is kind of as forecasted, right? A fairly modest third quarter, or the encircled numbers, and you see the fixed income returns in the first third of that exhibit, left to right on the top of the page. In the broad fixed income markets there, you can see we're essentially flat in Q3. I'm using that third line in core bond, and actually down a bit calendar year to date, right, by virtue of interest rates moving up a little bit. The story is a more constructive one for equities, but not materially so. You see that in the middle of the page there with the gray vertical bars, and as mentioned, right, large cap names in the U.S. modestly outperforming the other segments of the equity markets globally. So a bit of a struggle in Q3, although most markets calendar year to date, again, right, are positive. You see their emerging markets, if you can make it out, probably being the laggard for all the reasons you read about, right? The China situation with the government getting a bit more involved there, and the Evergrande Property Fund working through some issues, and that has been a bit of a contagion effect there into some of the other emerging markets. And then the kind of the reopening trades, if you will, or segments of the markets, things like commodities and REITs and the like, other real assets in an environment, right, where inflation has been a bit nettlesome. There have been some decent returns in those areas of the markets. So you bring it all together, as mentioned, right, a fairly nondescript Q3, although the numbers, as we'll see, calendar year to date through September continue to be fairly compelling. So with that, Mr. Chairman, before we spend a minute or two on the portfolios, any thoughts or questions from the board just on the bigger landscape economically or with returns?
I see a question from Ethan.
So I guess, Ethan Goldman, member. My question, Chris, is, I hadn't thought of it. I work in manufacturing and we're on our third or fourth price increase from vendors. Advice. And it'd be wonderful to think it's going back, but I don't know if it is. I don't think it is. Is there a different investment strategy if we think there's significant inflation in the future?
It's a great question, Ethan. Chris Cashmore, Fiducian Advisors. Great question and a fair one. If you think just historically, right, across bigger asset class segments and kind of what does well and doesn't when there's inflation, and you tease the statistics out, I think this group knows this, but it's worth repeating, right? Equities tend to perform okay, right? When we've got higher periods of inflation, they generally hold up reasonably well. Segments of real estate, depending on where you are, can hold up okay. Certainly real assets do. The fixed income markets, right, tend to be the area that can struggle when inflation runs and presses a bit higher. And that would be an area kind of concern and something to monitor and watch. So, I think when you look at your portfolio, right, by virtue of the strategic allocations, the vast majority of it, we think, right, at least from a historical context, has the ability to protect and defend against inflationary environments. Just as a reminder for the board, right, I think we've talked about this in a couple of our last previous meetings, but it's again worth repeating. In our next quarterly production, you're going to have the benefit of our latest capital market assumptions. So we are going to kind of step back and wholly recast your existing allocation and optimize it versus our very latest inputs, capital market inputs. That works ongoing as we speak. And I think Ethan will have the benefit, right? And it'll kind of work nicely because we'll be kind of mid-cycle with the application of your POB proceeds as well, right? We'll have completed 3 of the 6 entry points, if you will. But it'll be, short answer is I think we'll have kind of a nice way to show you some of those different mixes and maybe introduce a couple of different asset classes and what the potential return effects could be. And I think it'll be a very timely conversation that'll get you more explicit data and context around what you may want to consider from an allocation perspective on a go-forward basis.
Okay. I just don't see, I hope I'm wrong, but I don't see inflation going away.
Yeah, and we would agree, right, that going away.
No, I mean, at the current rate.
Oh, at the current, yeah. That and very well could be several quarters at least of this type of elevated inflation, but certainly bears monitoring for sure. So I think good data for you at the next meetings with our 4Q production to really have a deep conversation. So I do want to stay on task here for the board. I know you've got other things to chat about. Could we jump, Lori, just quickly to slide, I think it's page 20, where we show the allocation portfolio. There we go. And again, if people can make the numbers out, the takeaways here are that from an allocation perspective, right, we're following the prescription of the board, right? We've completed 2 of the 6 dollar cost averaging exercises and just running out, as we've talked about, in somewhat of a pro forma fashion, monies across the portfolio. So I think from an allocation perspective, we're in pretty good working order. The caveats I would offer up to the board as we come into calendar year end. Just a couple of things on the manager front. The lineup here, there are 2 strategies that have elevated statuses from our research team. The first of the 2 is the Met West bond strategy. We have elevated that to what we call discuss. It does not compel action from the board from our perspective, but just to give you a little color there, one of the longstanding portfolio managers responsible for that strategy is retiring at the end of the calendar year. A gentleman named Tad Ravel. is leaving the organization. He has worked alongside two other co-portfolio managers for the greater part of 15 years. And those two gentlemen are kind of fully ensconced in the Met West way, if you will. And Tad admittedly was one of the architects of that approach, but they're very well versed in it. We think ultimately that the strategy will be just fine going forward, but we do want to, for the board's knowledge, just to remind you or suggest or let you know that we do have an elevated status there, just to walk us through that retirement. I suspect we'll go back to maintain on this strategy in fairly short order. The other one, if you work your way down the page, is the Hartford Diversified International Strategy, one of your 4 dedicated international equity managers. You'll recall that we did elevate that strategy to watch. That strategy was elevated to watch because there were some changes in that portfolio management team. A couple of gentlemen left the strategy, and the team that runs that, you'll remember, it's a sub-advised strategy. Marathon Asset Management out of London is actually the investment manager for that Harbor strategy that you've got. And they have brought on a gentleman from Fidelity who we know, who's got a very compelling track record, who's going to be responsible for emerging markets and other certain Asian segments of the portfolio, and has been doing it successfully, investing there for the better part of 20 years. But it is a change, and it is meaningful enough where we do elevate the strategy to watch. Here's the kind of the one implication, or the one thing that I'm thinking through out loud, and obviously welcome the board's perspective on this. There can be circumstances when we elevate a manager to watch where we're not comfortable providing them fresh capital until we see that situation, work its course or redeem itself. So as we all know, right, at the end of December, all things equal, that strategy would be the recipient of some monies, right, in wave 3 of your dollar cost averaging exercise. I'm waiting on kind of the very latest and greatest from our research team. I'll have discussions with them this week on that front, and certainly advance of this exercise to see their comfort level and whether we're comfortable providing fresh capital to them, or we'd prefer to kind of stay the course with what we've got and let them kind of work through this issue. So I guess the one consideration for the board, and again, it's something we've got time on, and we can share with you more topical perspective as we come into the end of the calendar year, is if what we would typically do if our research team says, hey, let's just hold off on fresh capital for the time being. What we would typically do is kind of prorate what would otherwise be going to Harbor, across the balance of the portfolio, with a focus, as you can imagine, on the other international managers, to keep that a segmentation true. So that could be one course of action that we come back to you with once we've got that research fully completed. So other than that, Mr. Chairman, I think that the lineup is in good working order, and we're kind of proceeding as directed with your edict. Let me pause there for a moment just on the allocation. Would welcome perspective from the board on anything just mentioned, or otherwise for that matter.
Chris, I think we covered this last meeting in October, but the real estate allocation is much closer now to the target. That's correct. Is that correct?
Yeah, we are catching up there, Lazaro, and based on forthcoming exercises, we'll continue to press on that underweight. The other thing, right, just a tease as well, is the portfolio continues to grow and size up with the POB proceeds. That, I think, Mr. Chairman, would be an area of the market or where you might want to look at alternatives or additions to Barings, right? So Barings is one form of real estate investing, right? You'll remember they tend to be a very plain vanilla, high grade type of a program, and that's perfectly fine. As you size up, there are other types of real estate investing, as you can all appreciate, kind of up and down the risk return spectrum, and at your ultimate size, when all your POB proceeds are deployed, it would not be atypical for a fund to have other complementary real estate mandates. So kind of in the back of our minds, we're just kind of thinking through ultimately where you may want to go with that. But yes, the short answer is we are working to true up that relative shortfall in these subsequent exercises.
And I know that like with our first when the first dollar cost averaging segment, we couldn't get that deployed because of the queue.
Right.
But going forward, we have a good idea of, each segment going forward for dollar cost averaging. So are you managing that queue almost in real time where we're not gonna lag?
Yeah, that's correct. Right. Yep, that's exactly right. So actually and I have not talked to them most recently, but the last time I talked to our analysts, the entry queue has been alleviated somewhat at Bearing. So I think that our capacity access will continue to be in line with your desire. So yes, we are kind of monitoring that and reacting accordingly.
Right. And at some point in your presentation, if you could just comment on the returns relative to the benchmark, just over various periods, they look like they're lagging. And I think you made some remarks about them being sort of more conservative and high quality, high grade. But maybe if you can just at some point dig into that a little bit deeper. And I do think if, at the next meeting, if you have some ideas around other real estate funds that we should consider either for diversification or, for whatever you're thinking from given everything that's going on in the economy and the markets and market conditions for real estate, if you've got recommendations or suggestions, we would welcome those.
Yeah, absolutely. And I think it'll dovetail perfectly right with the allocation output and the portfolio construction discussion. So that's a perfect segue. Thank you. So we will certainly mention those numbers momentarily. If we could, Lori, skip to the very next page, just so the board can get a quick sense. I think, again, we had previewed these numbers a bit at our October meeting, but you see there, if you can make it out down in the middle of the page for the quarter. Again, kind of a nondescript quarter, right? The portfolio, at least on our ledger, down about 40 basis points, about what the benchmark was down. Really nothing of particular concern. The year-to-date number you see up 9% through September. Benchmark up about 7.9%. The one-year numbers continue to accrete pretty favorably, as you can make out there, 22% in change versus a benchmark of just around 20-ish or so, a little less than that. So, and the longer-term numbers still accreting pretty consistently north of the benchmark net of fees. So I think that the bigger picture story from a return perspective, remains a constructive one, which of course is encouraging. To the chair's inquiry, if we, Lori, just scroll ahead here, I won't go through each and every one for sure, and I know that there's a lot of numbers on this page, but generally, we've been fortunate, right, that the active managers that you have had in the program longer term have by and large been kind of up to task in terms of relative returns. Quarter here, quarter there for sure, where there may be a bit of a security selection challenge or an over and underweight to a sector that might be proved challenging. But the longer dated numbers for most of your mature managers have been pretty favorable, of course, and as displayed in the composite returns. But to the chair's question, if you scroll, Lori, to the very end, it's the next page. It might be one more. If you might be one, there we go. If you can make them out. So there's the Bearings numbers down at the bottom of the page, and you can see their numbers. Just as a reminder, their benchmark is actually a composite of the other open-ended core funds that they're out there in the marketplace, right? So unlike some benchmarks, S&P 500, Russell 2000, the aggregate bond index, actually the Bearings peer comparison is the average return of other openings in that of other managers, in that open architecture structure. And I think there's about 9 or 10 managers running similar strategies that we have access to. To the chair's question, Barings has long used much less leverage than many of their peers. And you see that on a relative basis in an environment generally that's been conducive to leverage, right? That conservatism has been, a bit of a headwind longer term, but it kind of is part and parcel just with we think, again, a very plain vanilla, a very high quality approach to real estate. We just want to get the benefit of those returns in a less volatile manner, right? And so we're entirely comfortable and kind of understand that differential being, again, a byproduct of a somewhat more conservative approach. So we don't have any concerns on the strategy, and they're really kind of doing kind of exactly as advertised, quite honestly. So I will pause there on the manager and performance front and see what questions you might have.
This is Perry Sloan. I have a question.
Go ahead, Perry.
Okay, go ahead. Okay, thank you. This is Perry Sloan, pension board member. Chris, so you mentioned it's a little bit more conservative, less leverage, and therefore leading to some less volatility. Do you have some measures of the volatility of that fund in particular compared to its peers?
You know what we do? I do have it, Perry, but let me bookmark it and I'll come back to you alongside the other request from Alan, because there's some statistics buried deeper in the report. I don't think it gets to that level though, but let me capture for you their relative volatility. We do track it and monitor it. And if it's okay with you, we'll report back to the board with that information.
Sounds good. Thank you.
Let me just make a note of it so I don't forget here. Anything else on? Looks like Al.
Al, go ahead. Alan, did you have a question?
Sorry, I forgot to unmute. Al
Okay.
Lebo, board member. Chris, could you just talk a little bit about the Silvercrest return versus the benchmark?
Yeah, if you go to let me see here, Lori. I just gotta make sure I pick up the page correctly. If you could scroll back to the previous page. Yeah, so Silvercrest, you'll see there, it's kind of interesting, right? Year to date, a bit behind, and that is a byproduct, Alan, of sector positioning for the time, is what has kind of hurt them recently. You do see, right, the longer dated numbers are a bit more competitive. If you, Lori, scroll ahead, and I meant to do this, and I apologize, I didn't get to it this morning, but if you scroll ahead, there'll be a more explicit explanation for Silvercrest in our commentary. So you all see there. I think it was just on the very bottom of that previous page. It might be one prior. At the very bottom of it. So if you take it out at the bottom there, right? So I'm not going to read this out. The board can read this as well as I can. But again, right, with all these managers, sector positioning, right, comes in and out of favor. They have, return patterns where their styles are kind of in favor or not quite as in favor based on the kind of underlying circumstances in the markets, right? Our litmus test, as you all know, I think it bears repeating, but it's important, is the totality of that track record through a market cycle, kind of fully being aware that a manager will periodically underperform benchmark. And to the extent that the thesis is intact, and as you see here with the maintained status for Silvercrest, that's our research analyst team's perspective currently, they're kind of doing as advertised, and I think ultimately it'll be perfectly fine. But a bit in the way of sector positioning and some security selection, more recently, that's been a bit of a headwind.
Well, look, Chris, even in inception to date, they haven't done all that well, and of course they're a higher cost fund, and it just, this just seems to me indicative of a situation where we're paying more and taking more risk and getting worse results out of it.
Yeah, I'd say though, Al, right, we have not experienced with them just yet, right? We haven't had the benefit of, we've had a benefit of a few years of returns, and we're certainly mindful of that shortfall, right? We do want to, we do want to give the manager the benefit, right, of not kind of, cutting out of them right at the point where we may be on the cusp, right, of a period where they'll kind of come back into favor. So your point's a fair one. It's well taken. Certainly the numbers to date have been modest. I'll use the term modest relative to peers. But I wouldn't move away from them just yet. As you remember, right, we certainly got periods with some of the other managers where that more recent numbers can kind of even afflict a little bit an intermediate track record, which is what we're seeing with Silvercrest. Pierre comes to mind, right, is one where we've had these periods and these data points where we've sat in meetings like this and looked at their numbers relative and absolute for that matter, where they've really struggled with benchmark, but the discipline you've used in the past, you've seen the reward for that. And I think that'll be the circumstance here for Silvercrest. But rest assured that hopefully the board knows, right, that our research team is certainly on that group regularly and is kind of working with them on what their thinking is and how they're doing things to make sure that the basic thesis is still intact. But we'll certainly keep tabs on it for sure. Anything?
Yeah, I've got a question, Lázaro Guzman, Chair. When you were talking about the economic backdrop, you talked about the uncertainty around inflation, rates potentially drifting upward. For the next meeting, maybe we can dedicate a little bit of time specifically to the fixed income portion. Specifically, we've got a little bit higher weighting in the Vanguard Index Fund. And I'm curious just your thoughts around, again, given some uncertainty around inflation and maybe higher rates, you talked about fixed income potentially being challenged in that type of environment. I just wonder if we have the right split between active and passive and fixed income. And then if you want to open that up to maybe adding another manager, I'll leave that to you. But I think just given the market backdrop, that's worth a revisit.
Chris Cashmore, Fiducian Advisors. Absolutely, Mr. Chairman. I think right with this group, I don't think this exact group, but I know perhaps for some of you through time, we've talked about other type of fixed income strategies that might have a better wherewithal to kind of defend in a more volatile rate environment. So again, this is perfect input for us, and I think really sets us up nicely in our next formal review to run through the asset allocation and portfolio construction and really look across the various asset classes and segments to see if we're still positioned in a manner kind of consistent with our best thinking. And I think at the larger allocation point, of course, you are there, but these these tactical, for lack of a better term, tilts and whatnot, I think are a good exercise for us on a go-forward basis, just to see if there's a little bit on the margin that we can do from a positioning standpoint. So I think that's a great feedback for us, and certainly something we'll look to flesh out in short order.
Thanks. I think we've got another question, and we do want to move on, but go ahead, Perry. Do you have a question?
Yeah, I do. This will be pretty quick. Perry Salonia, pension board member. So on the fixed income front, first off, I completely agree with the chair on that. But just on top of it, I'm curious what the current duration of the existing fixed income portfolio, if you know offhand, and if you don't, regardless, one of the things I would like to understand a little bit more about is tactical strategies around looking at the duration of whatever the new fixed income portion of the asset allocation might be. And obviously, duration is a measure of sensitivity to interest rates. So if we're talking about inflation going up and then correspondingly, potentially interest rates in general going up, that's one thing that I'd want to look at and potentially consider for everyone else as well.
Chris Cashmore, Fiducian Advisors. Great question, Perry. I think today that the duration of the portfolio largely mimics the ag, right? So I think the ag, with the Lehman Brothers, the Barclays Capital Aggregate Index today has a duration of 6.5 years, something like that. And I think MetWest and obviously the index are fairly close to that, right? If everyone remembers, right, kind of the metric, the basic metric around duration with call it a 6-year duration, were interest rates to go up across the yield curve overnight by 100 basis points. In theory, that means the portfolio would go down by about 6% in value, right? Not likely to happen, but that's the duration metric. To the second part of Perry's question, there are certainly strategies out there that have more flexible toolboxes, right, to work alongside that duration. So-called unconstrained fixed income managers and the like that can kind of work more actively on duration stancing and defenses against higher interest rates, for example, are certainly in our toolbox and are certainly things that we are aware of and research and we'll bring those ideas to the board as well. I think it is good perspective from both the chair and from Perry.
Thanks, Chris.
Mr. Chairman, anything else? The only thing I wanted to do, if you would grant me for 30 seconds time, Lori, if you jump to page 36, because I know the board had asked this at a prior meeting. We have begun, we've got a couple months now, right, of activity for the POB portion of the portfolio. If you could continue, Lori, let's see, keep scrolling ahead another page or two if you would. Here we go. Thank you. One more. So, I mean, there's nothing all that elaborate here to show, but you'll remember you did adopt a mix of 2 very short term and one more, what we'd call short intermediate term strategy in the form of Baird, paid in the Vanguard portfolio, right? So no surprises, pretty darn close to target as you would expect. We're drawing from them proportionally to fund your dollar cost averaging exercise at each quarter end. So we'll continue to monitor. All 3 of the strategies are in good working order from our standpoint, and no particular issues there. Baird and Payden, you'll remember, operate at the very front end of the yield curve with durations of about half a year. And they have, as you would imagine, right, correspondingly modest yield profiles. If you look at their SEC yields, I think Payden is 30 basis points today and Baird's about 50 basis points. You'll remember the board had a desire to introduce the potential for a little bit more yield in return. That is going to come from the Vanguard strategy that has got a duration of about 2.5 years today, operating again on the front end of the curve, but also offering up more than twice the yield. I think it's about 120 basis point yield for the Vanguard strategy today. And the expectation, right, is that combination of 3 over the course of the exercise, at least historically, right, has always offered up a little bit of a way of an advantage over money markets, and we'll see how that all fleshes out. If you go to the very next page, Lori, just so the board has it, and these are obviously net numbers, right, with fees incorporated, but you'll see the portfolio in the very kind of upper left-hand corner of the page, right? We've got just a kind of a couple of months activity there, essentially flat, if you want to call it that. Just inception to date, really, I don't think there's tremendous explanatory power in these numbers just yet, right? Because it's such a short tenure, but certainly something I think from a construct perspective that is in good working order. And again, I think, right, with the benefit of, several months and some time for them to reinvest cash flows and do the things that they've historically done under the hood, you should meet your objective there for just a modest positive return with the obvious additional guidepost of principal protection. So I will pause there for the chair and for others if there are any questions.
Thanks, Chris. Doesn't look like we have any questions. Appreciate the analysis. Thank you.
All right, I will, Mr. Chair. I didn't have anything else prepared for the board. I will.
All right, we will continue on with the agenda. Next up, we've got Brittany Birmingham. We'll speak about town matters. Brittany? I don't,
She must have gotten up. I see that
is that,
she's not
yeah.
she's not at her desk.
All right, so we'll come back to her. Let's go to Rick. Let's see if Rick's on. Oh, there's Rick.
Morning, everyone. Rick Ledwith, Executive Director of HR. Our meeting schedule for calendar year 2022 can be found on page 6A of your board packet. And the next meeting will take place on January 24th, 2022, followed by a meeting in February. And with any luck, we may be in person for our May meeting. But at least the next two meetings will be held virtually. If anyone has any conflicts, just reach out to Lori.
Great, thanks, Rick.
Thank you.
All right, we'll circle back to Brittany. Brittany, anything with respect to town matters?
Yep, sorry about that. Nope, nothing to report.
Right, great, thanks, Brittany. Formal actions. So we'll start with the minutes. I did have one comment on the minutes, Lori. Just if you could make maybe one change, and I would, I don't mind approving pending the change. However we need to work that. But on page 8, new business, section 2. Let me find it here. Where I'm quoted saying that the decision to invest in POBs, if we could just change, instead of the decision to invest, the decision to issue pension obligation bonds was outside of the scope of the pension board.
Could you repeat that, Lazaro?
The decision to issue pension obligation bonds. So I'm just changing.
Changing invent to issue and invest to issue.
Yes.
Okay.
That's it.
Sure.
With that, so can we still make a motion to approve just pending that change?
Yes.
All right. Motion to approve the minutes from the last meeting, and unless we have any objections, I'll make a motion to approve by unanimous consent. Any objections?
Mr. Chairman, it's Pete Privatera. I have to abstain from that since I was not at the meeting.
Okay. Thanks, Peter. Any other objections or abstentions? All right. Motion passes.
Thank you.
Thank you. Give me a second here. Get my bearings. Next on the agenda, pension administration.
Ledwith, Executive Director of HR. Nothing out of the ordinary for pension administration for new members, non-vested withdrawals, and vested interest approvals. As Peter mentioned earlier, we do have 5 bills from Milliman for your approval, and we wanted to talk through a couple of things with those bills. First, you'll notice that several of these bills are past due, with one going back to February of 2021. And Milliman had changed the way they send out their bills, and unfortunately, they had got caught in our spam email, so we did not notice them for a couple of months and had missed them. But we are all set now from an administrative standpoint, and we'll process all future bills on time. We also wanted to let the board know that we have removed, if you go to the first bill on 7C1, wanted to let you know that we did remove $4,762 in charges related to the town manager's projected retirement benefits, and we did charge these fees to our risk fund, so they are being removed from the pension fund and will not be processed as part of today's approval. So on that bill, you would be approving $13,985 instead of $18,747. And then we also have two Silver Crest bills for the last 2 quarters of 2021. Anything you would add, Peter, to that?
Pete Privatera, Finance Director. No, it was unfortunate that Milliman went to a third-party billing service, and I'm sure most of you, like we do in finance, get hundreds of emails every day from vendors trying to sell you things or trying to ask you to tap on a link to open a file. Unfortunately, we didn't realize that they were representing Milliman at the time, so we didn't open the files up. In accordance with our protocol, if you don't know who it is, don't open it up. So we've since realized who it was and processed the bills. I do know that there's going to be some questions on the amounts of bills and what was approved and what wasn't approved. I'll try to answer any questions anyone might have on that. Thank you.
Al, go ahead. You have a question.
Yeah, I have a couple of questions. This is Al Lebo, board member. First of all, Peter, are we going to be paying the late fees, or is that going to be waived?
I don't think we're going to be paying the late fees. I have to have a conversation with Becky, to be honest with you, about this. Because there was at no point in time did Becky or anyone from our office pick up the phone and call me and say, "Hey, Pete, you have outstanding bills. What's going on?" We would have realized the issue right away and we would have rectified it. So I'm going to work this thing out with her. I can't believe that they put us in that position.
Okay. And then the second question I had, I see on here that bills list how many hours people work, but I assume that there's much more detail behind this that shows exactly what hours were worked and what was done during those hours and stuff. First of all, is that true? And secondly, have you or somebody in your staff been through that to verify that those really seem reasonable? Because some of the charges on here just seem quite large to me.
I'm sure there is backup on each one of the bills and the hours that were identified. This is not an excuse, but just an explanation. You have to understand that while all this was going on, we were being pulled from 3 different directions. There was information requested from the pension board. There was information requested from the rating agencies. There were different scenarios requested from the treasurer's office, from the OPM office. And we're pulling all this information along with Milliman. This was, as you all know, this was an extraordinary event, for all intents and purposes, a once in a lifetime event for us, the biggest issue we had. So at the time, our concentration was, let's get all the information that's requested. Obviously, a decision was made to move forward with the issuance of the bonds. And as you all know, it was an incredible success. We got to maintain our credit rating with both agencies, and we issued bonds for an incredibly low amount. And we're going to save the town millions of dollars. But, there were times, and I'll be honest with you, there were times at certain points of the year, unfortunately, the pension board does not meet on a monthly basis, that, analysis was requested, and we just immediately responded because we were under time constraints. And, we would ask Milliman, okay, we got this request from the state treasurer, can you run these scenarios? Or even Al, in some cases, you had asked Becky to run different scenarios for you on various, asset returns. So I can ask them to provide us with the detail backing up every hour. but I'm sure they can provide it. If that's what the pension board wants, I certainly can request it. Thank you.
Thanks, Peter. Let's I guess let me make a few comments and then we'll see kind of where we go from here. So when we did have an additional set of projections, and Peter, thank you, because I think the fact that you were being pulled in different directions, responding to requests from the rating agencies, responding to requests from the state treasurer, I think adds a little bit more clarity as to why maybe there were, that there was so much consulting and modeling. I did look at, I think it was the 614 invoice, and that specifically spiked out the additional scenarios that we had requested. And we had put a limit of, I think, 5,000 for that consulting and modeling, and it came out to about, I think, a little bit over 6,000 between it looked like the modeling and then also presenting the results at the meeting. So I was able to tie that back. But Peter, from your perspective, because there are a lot of charges with or for consulting and modeling and different things related to pension obligation bonds, I think you know better than we do in terms of all the different requests that were going on. From your perspective, are all the charges in terms of hours spent, putting aside the dollar amount, hours spent, does that seem reasonable at this point?
Pete Privatera, Finance Director. I would have to say that well, first of all, there are some charges on here that are not pension bond related, that were administration related, and Rick or Paula can speak to those if there's questions on it. But when we first went down this path, the pension board approved, I think it was $20,000 for an initial creation of a model and modeling by Milliman. As we were going down this path, it became apparent, as time went on, that we needed to spend more time because there was a series of additional modeling, meetings, presentations, and I think the board came back, and I think there was another $5,000 or so that was approved, and then obviously there was some funds that were approved for additional modeling by the pension board. But I think since this was such an extraordinary event, when we're in the thick of it, and if it's during a period of time in the fiscal year when the pension board is meeting and decisions have to be made to move forward, decisions were made to move forward. So, I don't think, I've worked with Becky for 15 years or so, and I don't think that they would have charged us for anything that they didn't document and they felt was relevant to this. I know that there were a number of meetings that Becky attended that she did not charge us for. But at this point, I'm comfortable with this. Moving forward, the only bills you'll see from Milliman are their management fee, and if there's any outside analysis that has to be performed for HR or for the retirements folks. But at this point, I would say that this should be it for us, and I'm okay with it at this point.
Well, if I can follow up, Al Leba, board member. So the reason I did ask the question that I asked earlier is that, of these bills, the one that, I'm most familiar with is the one that Ladro mentioned, the June 14th bill here, for the scenarios that I specifically had asked for. And again, we had discussed this with her ahead of time. She had quoted a number of $5,000, which I thought was extraordinarily high. She said it was unlikely that we were going to hit that kind of number. And now we have a bill here for over $6,000. And so that's surprising to me. And that's just that one. I don't know about the other bills. I find that kind of disturbing.
Go ahead, Peter. Hey, Peter, you might be on mute. You're still on mute, Peter.
How about now?
Yes, now we can hear you.
Okay, sorry.
No worries.
Pete Privatera, Finance Director. Al, I can't comment on that because, you know, you were working directly with Becky and you know how many hours you and Becky worked on the scenarios that you had requested her to do. We certainly could, you know, contact her and have her break that down and say, you know, you charge us $6,000 for all those scenarios, but we're under the impression it was going to be, you know, $1,000 or $2,000 at the most. You know, that's we can track that down a lot quicker than we can on the rest of them because, again, don't forget this whole process. It wasn't static; it was a dynamic process. I mean, you know, I was dealing with, as I said before, you know, three different agencies, you know, the town council and you know, we're trying to respond in a timely manner because we're under the gun here. We had to get all this information and analysis done in a specific period of time. So is it possible that, you know, we spent a little more than was approved? Yeah, it's very possible. And again, because of the timing of the meetings of the pension board, there was no opportunity to go back and say, okay, we need to call a special meeting because we need to spend a couple $1,000s more. It just wasn't feasible. So I would say with the question that you have on your bill, we certainly can go back to Becky and ask her to break that down. Absolutely no problem. With the rest of the bills, I certainly can go back and ask her for a breakdown of, you know, what's going on with, you know, with the bill. Can you tell me what analysis did you do for OPM? Which one did you do for the treasurer's office? Which one did you do for Moody's? I mean, I can ask her to do that if that's what the board wants. But I think, you know, because of the outcome and because of the position that we're in now as a fully funded pension, you know, and the amount of money that we're talking about here, I don't know if it's worth, you know, pursuing. Thank you.
Okay, well, if we could get, and typically I thought the consultants break this down into like 15-minute intervals. If we could get that, you know, breakdown for particularly this one bill, I would appreciate that. I guess I would have thought that when these bills come, they have the backing of those 15-minute breakdowns. Is that not the case? Is this actually the bills that we get, and they don't have any further breakdown to them in general?
Mr. Chair, Pete Privatera, these are the bills that we received. We certainly can ask for the backup on the bill and ask them to provide it. I'm sure they have it, but this is what we received from Milliman.
So I think we can maybe dig deeper into the June 14th bill. You know, I suspect, I'm not sure, this is my perspective, folks can tell me what they think. My perspective is, to Peter's point, you know, there were requests from 3 different agencies. There were requests coming in from the state treasurer's office. Ethan, I see you, I'll get to you in a second. There were multiple requests that needed to get responded to outside of our meetings, and so rather than hold up the process, I think the work needed to be done to make sure that things stayed on track for the issuance of the public obligation bonds. So I'm comfortable with digging in deeper into our specific request. But my thoughts would be to approve the other ones, just given that, you know, I think some of the other folks are in a better position to understand what requests were being made from where, and if the work, you know, if Peter feels that, you know, that sort of reconciles with his recollection of the different requests, and, you know, I'm not sure what value there is to kind of digging into the other ones. But I'll pause there. And Ethan, you had your hand up.
Yeah, I just had a couple questions. I'm just trying to understand. I'm sorry, Ethan Goldman, member. I'm just trying to understand the context. Was there a budget set for this in terms of the pension obligation bonds? And also, is there a normal fee? And was this all that there was for the pension bonds? Because in total, it doesn't seem that unreasonable. I'm just trying to understand the context, sorry. Thank you.
Yeah, I don't remember a total budget. Just based on, I think some of Peter's comments, we talked about $20,000 for modeling and then another 5,000 for additional scenarios. But, I think the budget that I'm speaking to was more what the board thought it was going to need. That did not exclude, or that did not include, requests that might come from the treasurer's office or requests that might come from the agencies.
No, I understand. I just came
yeah.
in while
Yeah.
pension board, that you guys had already, you were already started down the path towards the obligation bonds. So I didn't know if that had come up in the past.
Right. No, I understand. Yeah. So that's, hopefully that answers your question. Peter, did you want to add to that?
Yeah, Ethan, as I said before, this was an unprecedented event. We did not know at that
Okay.
point what the cost was going to be. We couldn't set a budget. We had an idea of what it could be, and that's what we based our initial request on.
Okay, thank you.
So, let's do this. In the interest of time, I'm gonna make a motion to approve pension administration. So all the memberships, terminations, and all invoices. Actually, before we go to the motion, any other questions on any of the other invoices, either from Millman not related to POBs or from the small cap fund? Yes, Al.
Al Lebo, member. Yeah, Peter, I'm sorry, Lazaro, when you make this motion, can you please do each one separately? The pension, enrollees separate from Milliman, separate from Silvercrest.
Pension administration should be separated from the approval for the invoices, yes.
Yeah.
Okay.
Yeah, thank you.
So I'll make a motion to approve pension administration. And unless there are any objections, we'll move forward under unanimous consent. Any objections? All right. So pension administration is approved. Invoices then. So we'll take each one separately. Invoice 1 dated February 5th, 2021. Motion to approve that invoice. I don't think we need a second. We just need to move to debate.
Les, I'm fine if you just want to do all of the Millmans together and all the Silvercrest together. I just didn't want to do them to,
Well, I was thinking we were gonna, so are you thinking, so my thoughts were we were gonna dig into the June 14th. And so I was gonna do all of them except the June 14th one. But if you want to do all the Millmans, so you have issues with more than just the June 14th?
No, I don't have, no, I'm okay with paying all the Millman bills. But I would like to request more information about those bills subsequent to approving the payments.
Okay. So motion to approve the Silvercrest bills. Any objections?
Yeah, I actually just would like some explanation on the Silvercrest bills as to what we're being billed for here, or how we're being billed. Is this just a basis point thing? Is there an incentive thing here? How's the Silvercrest bill work?
Chris, do you want to speak to that?
Sure, Chris Cash, Fiducian Advisors. I think, Al, it is just the management fee charge itself. There's no incentive structure for Silvercrest. It's just a flat fee arrangement. The one a little to note is that Silvercrest actually bills on a forward basis. So they use the beginning of the quarter value, and then so for example, they're billing you, I believe, with 9/30 numbers, right, for Q4. calendar year Q4, through December. So they're billing in advance. We see that occasionally. It's more frequent where you'll see billing in arrears, right? Well, they'll bill you at the end of December for, Q4, or some averaging mechanism as well, you'll see. So the only, I guess I'd offer up, the only unusual thing about that bill is it does bill in advance. I think over time, right, that ultimately kind of trues itself up, but it is a little bit of a somewhat unique of a framework for them. But it's just their baseline management fee, and unlike the peer fees, for example, there's no additional incentive or compensation for them away from their management fee.
All right, well, I guess I'm not going to have any objection to paying the bill, but they are a high-priced advisor, 80 basis points. The fee's $50,000 here, and I don't think that the return we get from them is proving to make that worthwhile.
Any other comments on the Silvercrest bills? Thanks, Alan. Motion to approve? Any objections? All right, those invoices are approved, Lori. And then on the Milliman, I guess I want to understand what exactly we're looking for, if it's for all the invoices or just the June 14th invoice. Is that something that everybody's looking for? So Al, you're looking for backup on all of the Milliman invoices or just June 14?
Yeah, Aliba board member, I would have thought that when they do their billing that they normally provide the backup. So yeah, I kind of feel like we should have backup to all of them, but nonetheless, the only one I'm familiar with and the only one I can really go through and sort of audit is that June 14th one. So the June 14th one's the only one I specifically am requesting.
Okay. And then in terms of, do you want to go through them? Because I think we need to pay, I think we need to start paying for some bills or all the bills. So I'm comfortable making a motion to approve all the bills with the exception of that one until further audit. Or what, I guess before I make a motion, if we're going to ask for more information, I would say let's approve all of them and then that one pending further audit. Yes, Peter.
Just a suggestion. First of all, excuse me, we're going to amend the first bill to remove the $4,762.50.
Right.
Because that's not coming out of the pension fund. I would suggest, and again, we have a current relationship with Milliman. And there are actuaries and they're going to be submitting bills as we go along for the management fee. I would suggest we authorize the payment of these bills, ask for an audit of that specific bill that Alan had discussed. And if we do find some discrepancies and we were overcharged in some areas, we would just deduct that amount from the next bill that comes in. This way we won't have to go approve part of it and go back and deal with it again. But we could deal with that. If there's an error, we can deal with it with the next bill that comes in. We can subtract that credit from that. That would be my recommendation.
I like that suggestion. So I'll go ahead and make a motion to approve all of the Milliman invoices. And then Peter, if you can get us some more detail around that June 14th invoice, that would be great. Any objections to approving the Milliman invoices?
Well, again, the invoices as amended for the 4,000.
Yes, correct. No objections, so those are approved.
Okay, thanks, Lazaro.
Thank you, Lori. I think we've got one other item. Well, anything else on pension administration or invoices that I haven't covered? New business. At the last meeting, we talked about a pension dashboard. So wanted to bring the board up to date here. We did start a working group consisting of Alan Lebo and Ethan Goldman. So they've put together some some thoughts around what that dashboard should look like. I'll be looking at that dashboard, and then I think that's something that we can review as a full board during our next meeting. Prior to that meeting, we'll make a decision if we're far enough along to get input to bring in whether or not to bring in Becky. And then, we can also show it to Chris, make sure that since they're the ones that are going to be providing some of the numbers to sort of report on that dashboard, we want to get their input, but I did want to kind of look at things first before bringing in our actuary. So that's where we're at. Any questions on that? Yes, Perry.
Perry Salonia, board member. So as you're working on kind of structuring how you think that might look, is that something I could be a part of as well? I asked because the last time we talked in October, it sounded like we might still need to figure out whether there is some what's the term? Freedom of Information Act that we had to consider and be mindful of.
Right.
Whether it kind of consisted of a working group. So I just want to get your thoughts, but if possible, I'd like to be part of that conversation too.
Right. So we can't the reason the working group was limited to Ethan and Alan is that we have to be careful not to have a quorum. If we had a quorum, at that point, the meeting would be considered an official meeting. So your input would be via the full board meeting.
Okay.
So we'll send out the materials. The dashboard will likely be sent out prior to the meeting, and then I would ask that at that point all comments and feedback be reserved for the actual meeting when the public has an opportunity to join.
Sounds good. Okay, thank you. And
Thanks,
how much time in advance of the meeting you think you can give me to be able to look at it?
We'll give you as much as we can, maybe a week or so.
Okay, thank you.
Ethan, did you have a question or comment?
Just a comment, is it worth adding additional time so we don't run up against time limits when we do discuss the dashboard? Just because this meeting's going over. So it's just a suggestion. You can take it as, I don't know the rules.
Yeah, let me look at the agenda. I think this meeting we had some more detailed conversation on investments and then the invoices. So I'll look at the agenda and sort of figure out how that agenda is looking and whether or not we need to kind of carve out a separate meeting. But thanks for the comment. Any other questions or comments on the pension dashboard? All right, with that, a motion to adjourn. Any objections? Thanks, everyone. Apologize for going a couple minutes past our time here. Hope everybody has a good week, and we'll be in touch at our next meeting and prior to that with some materials. Thank you.
Thank you, everybody.
Bye,
Take care.
folks.
Bye now.
Thanks.